In 1962, a nurse in Chicago named Carol earned $6,200 a year, more than the man sitting across the desk from her. She had no debt. She had never missed a bill payment in her life. She had $1,400 in a savings account she had been building since 1957. The bank denied her mortgage application in 4 minutes. The reason written on the form: applicant is female and unmarried. That was not a mistake. That was not one bad loan officer having a bad day. That was the law. Before the Equal Credit Opportunity Act passed in 1974, American banks operated under rules that made it legal, in many cases mandatory, to deny women credit regardless of their income, savings, or repayment history. Some reasons were written directly into bank lending policy manuals. Others were industry conventions so widely practiced that no one questioned them. 25 of those reasons are documented here. Some will make you angry. Some will make you disbelieve they were real. Every single one of them was. Coming up, reason 14 is the one that affected millions of married women who had been paying their own bills for decades and were still invisible to the credit system. Reason 8 is how banks denied credit to women who earned more than their husbands. And reason 3 is the policy that punished women for doing everything society asked of them. If you or someone you love lived through this system, subscribe. This channel recovers what history forgot to write down. Here are 25 legal reasons banks said no to women before 1974. Reason 25. She was not her husband. In most American banks through the 1960s, a married woman's credit application was processed under her husband's name, not her own. Her payments built his credit history. A school teacher in Cincinnati named Ruth paid every bill in the household for 19 years. When her husband died in 1968 and she applied for a credit card in her own name, the bank told her she had no credit history. 19 years of payments existed only under his name. She was starting from zero at 51. She had never missed a payment. The bank had no record she existed. Reason 24. She might get pregnant. Banks in the 1960s routinely discounted a woman's income from mortgage calculations on the grounds that she might become pregnant and leave the workforce. A loan officer's manual from a major Midwestern bank in 1967, cited in congressional testimony, instructed officers to apply a 50% discount to any female applicant's stated income unless she could produce a doctor's letter confirming she was sterile or past childbearing age. Stated intention was not proof. A woman's income was not real income until biology made it permanent. Her paycheck was real. The bank decided her future was not. Reason 23. She was not the head of household. FHA lending guidelines through the mid-1960s classified women as secondary borrowers by default. A married woman could not be listed as primary applicant on a joint mortgage, even if she earned more than her husband. The head of household designation on every FHA-backed loan was reserved for the male spouse. A woman listed as primary applicant triggered an automatic review that restructured the application with her husband as primary borrower. If she was unmarried, the head of household field was left blank, and a blank field was grounds for denial. The form had no box for a woman who owned her own income. Reason 22. Her job was not a real job. Jobs predominantly held by women, nursing, teaching, secretarial work, retail, were classified in many bank lending frameworks as unstable income sources, regardless of salary or duration. A department store manager in Atlanta, named Beverly, had held her position for 11 years when she applied for a home loan in 1965. Her salary was $8,400. Her male counterpart earned $9,200 for the same role. The bank approved his application and denied hers. Retail management was an unstable employment category. The policy did not name gender. It did not need to. The occupation code on the form did the work the law was not yet allowed to do. Reason 21. She was recently divorced. Divorce left women in a financial classification banks treated as a permanent red flag. Bank officers described the concern as a character issue, a term appearing in lending documents without definition, applied almost exclusively to women. A legal secretary in Boston named Margaret divorced in 1963, returned to full-time work, paid off every shared debt within 2 years, and was denied a car loan in 1966 on the grounds that her recent marital disruption represented an unacceptable stability risk. Her credit was clean. Her character was flagged. The flag had no definition. Reason number 20. She earned tip income. A waitress in Las Vegas named Donna deposited between $180 and $240 in cash every week from 1961 to 1969, 8 years of consistent bank deposits. When she applied for a home improvement loan in 1969, the bank counted only her hourly wage of $1.10, $2,288 a year, and denied the loan. Her actual annual income exceeded $10,000. The bank's position: it could only lend against provable income. 8 years of deposits were not proof. 8 years of deposits. The bank saw only the hourly rate on the form. Reason 19. She had no male cosigner. Single women needed a male cosigner, father, brother, employer, for loans above $300 to $500 at most banks. Married women needed their husband's signature on any major financial instrument regardless of their income. A college professor in Ann Arbor named Dr. Patricia earned $14,000 a year in 1970, held a doctorate, and had published 2 books. She applied for a $3,000 research loan and was told to bring her father to co-sign. Her father was a retired factory worker who earned less in a year than she earned in a month. She needed her father's signature to borrow money she could repay from one paycheck. Reason 18. She was a widow. When a husband died, his credit file closed. His widow's independent file, if one existed, started from zero. Banks had no mechanism for transferring a deceased husband's credit history to his widow. A retired teacher in Portland named Eleanor, widowed in 1967 after 31 years of marriage, was denied a credit card in 1968. She was 62, had never missed a payment, and had managed the household finances for 3 decades. The bank's response: without a current credit history in her own name, they could not assess her credit worthiness. 31 years of financial reliability. The bank had no file for it. In 1972, the National Commission on Consumer Finance found that 63% of banks applied different lending standards to women than to men with identical financial profiles. The banking industry's response: the risks associated with female borrowers were real and financially justified. The Commission found no evidence to support this. Congress took until 1974. Reason 17. She worked part-time. Part-time employment was classified by most banks as temporary income, excluded entirely from loan calculations. A bookkeeper in Philadelphia named Irene worked 25 hours a week for the same employer for 7 years, earning $5,600 annually. Banks applied a blanket exclusion to part-time income regardless of how long or how consistently it had been earned. Irene's application was processed as though she had no income at all. 7 years with one employer. The bank counted it as 0. 7 years of reliable work. The bank counted it as 0. Reason 16. She had a hyphenated name. Banks assumed a woman's financial identity changed entirely at marriage. Women who kept their birth names created processing inconsistencies that were flagged as fraud indicators. A journalist in New York named Catherine, married in 1961, kept her professional name. She was denied a credit card in 1964 because her name on the application didn't match her tax returns, which used her married name. She was asked to choose one name. She chose her professional name. The bank denied the application. Financial identity, unverifiable. Her name was a fraud indicator. Her income was not the question. Reason 15. She was under 25 and unmarried. A bank policy memo from a major East Coast institution in 1966, cited in Senate testimony, described unmarried women under 25 as financially unanchored. The memo did not apply equivalent language to unmarried men. A flight attendant in Dallas named Sandra, 23 years old, earning $7,200 a year, was denied a car loan in 1966. The loan officer's denial form noted that her employment category required mandatory retirement at 32, the airline's forced retirement policy for female cabin crew, making her income projection unreliable. Her employer would force her out at 32. The bank used that against her at 23. Reason 14. Her credit history belonged to her husband. Joint accounts throughout the 1950s and 1960s were reported to credit bureaus under the husband's name only. The wife's payments built no credit history of her own. A homemaker in St. Louis named Frances managed every financial account in her household for 22 years, paid every bill, negotiated every credit arrangement. When she applied for her own credit card in 1969, the credit bureau had no file for her. Every account she had managed existed only under her husband's Social Security number. 22 years of payments. Not one of them was hers in the eyes of the system. Reason 13. She lived in a community property state. In the 9 community property states, married women's income was legally their husband's to control. Banks used this framework to require a husband's signature on any financial instrument his wife entered into, not as bank policy, but as a legal requirement under state law. A teacher in Texas named Gloria earned her own salary and paid her own taxes. When she applied for a professional development loan in 1968, the bank told her that under Texas law, her salary was a community asset. Her husband's signature was required to authorize her access to her own income. Her salary was her husband's to authorize. Texas said so. The bank agreed. In 1972, the National Organization for Women submitted matched applications from male and female applicants with identical credit profiles to banks across 12 cities. In every city, the male application was processed faster. In 9 of 12 cities, the female application was denied outright. Reason 12. She was a minority woman. Black women, Hispanic women, and Asian American women faced every reason on this list, plus an additional layer of racial exclusion through redlining and neighborhood assessment practices. A factory worker in Detroit named Josephine Black earned $8,100 a year in 1969 with $2,200 in savings. She applied for a home loan in a racially integrated neighborhood. The stated denial reason, property value instability. The actual reason was in the assessment notes Josephine was never shown. 2 forms of denial, 1 form to show, 1 set of notes to hide. Reason 11. She was self-employed. Self-employment income was treated as inherently unstable, regardless of duration. A dressmaker in San Francisco named Helen ran her own business from 1954 to 1969. 15 years, income growing from $3,200 to $11,400. The bank told her that self-employment income could not be verified and that her home-based business did not constitute a bankable enterprise. A male tailor operating the same type of arrangement in the same city was approved for a similar loan the same year. 15 years of growth. The bank called it unverifiable. Reason 10. She was about to turn 65. A registered nurse in Cleveland named Agnes, 63 years old, applied for a home improvement loan in 1971 to repair the house she had owned outright since 1958. No mortgage, no debt. A pension built over 28 years. The bank denied the loan. Her projected post-retirement income made the repayment schedule uncertain. The loan was $4,200 over 3 years. Her pension alone would have covered the payments. She owned the house outright. The bank denied her a loan to repair it. Reason 9. She had a child under 12. Childcare costs were applied as a direct reduction against a mother's stated income, not a recorded expense, but an assumed liability estimated by the loan officer without asking. A social worker in Minneapolis named Jean applied for a car loan in 1967. Her stated income was $7,800. The officer deducted $2,400 for estimated childcare. Her actual childcare cost was $600 per year. Her effective income was calculated as $5,400. The loan was denied. She did not find out about the deduction until she asked why. The bank subtracted an expense it estimated without asking her what she paid. Reason 8. When a woman earned more than her husband, banks treated it as a stability concern rather than a financial strength. An accountant in Pittsburgh named Dorothy earned $11,200 in 1968. Her husband, a schoolteacher, earned $7,400. Their joint mortgage application was processed at his income level. Bank policy used the lower of the two incomes as the stable baseline when the primary earner was female. She earned more. The bank used his number. His number was the stable one. Reason 7. She had an Irish, Italian, or Eastern European surname. Banks in immigrant cities maintained informal lending hierarchies that classified applicants partly by surname. A telephone operator in Boston named Kathleen McGuire applied for a personal loan in 1963. A colleague named Catherine Morgan applied for an identical loan at the same branch the same week. Kathleen was asked for a cosigner. Catherine was not. Identical incomes, identical employment records, identical savings. The branch manager later described Kathleen's application as a higher community risk without further explanation. Same branch, same week, same numbers, different surnames. Reason 6. She had no telephone listed in her name. Credit bureaus use telephone directory listings to verify borrower identity. Women listed under their husband's name had no independently verifiable identity in the system. A secretary in New York named Anne, 31 years old, was told during a credit application in 1965 that her address could not be verified. No telephone listing appeared in her name. Her phone was real. The line was in her landlord's name. The credit bureau could not find her. Her phone worked. The directory said she did not exist. Reason 5. She had recently changed jobs for a promotion. A man who changed jobs for higher pay was upwardly mobile. A woman who did the same was unstable. A chemist in New Jersey named Barbara moved to a competitor in 1968 for a $3,000 raise to $13,000. When she applied for a mortgage 3 months later, the bank denied her for insufficient tenure at her current employer. 6 years at her previous employer was not considered. The application required current employment history only. His job change was ambition. Hers was instability. Same move, different verdict. Reason 4. She banked somewhere else. A department store buyer in Chicago named Ruth applied for a mortgage at a bank where she did not hold accounts in 1966. She was told the bank preferred established customers and invited to open a savings account and return in 12 months. She did exactly that. The bank approved 60% of her original request, citing insufficient relationship history despite the 12 months she had just spent building it. She did exactly what they asked. They moved the line. Reason 3. She had just gotten married. A woman who had built her own credit as a single person frequently lost it the moment she married. Banks expected her name to change. Credit bureaus expected her file to merge with her husband's. Files that did not merge cleanly were closed. A librarian in Seattle named Margaret had built a 5-year credit history before her marriage in 1963. 6 months after the wedding, she applied for a credit card and was told her pre-marriage file could not be located. The single woman and the married woman were treated as two different people. The 5 years vanished. 5 years of credit history. Marriage erased it. Reason 2. She asked too many questions. A business owner in Phoenix named Clara was denied a small business loan in 1970. She asked for the denial reason in writing. The loan officer told her, insufficient track record. She pointed out that the business had been operating for 4 years with documented profit growth. The loan officer noted on her file that she was combative and uncooperative. She was denied again on review. Women who questioned a denial were flagged as difficult applicants. The flag was enough. She asked why. They wrote it down. It cost her the loan. Reason 1. No reason at all. The Equal Credit Opportunity Act of 1974 required lenders to provide a specific written reason for any credit denial within 30 days. Before 1974, banks were not required to explain why they said no. No documentation, no appeal, no accountability. A woman walked out of a bank with a denial and no legal right to know why. Carol, the nurse in Chicago we opened with, was denied in 4 minutes in 1962. The reason written on the form: applicant is female and unmarried. She was one of the lucky ones. At least she knew why. In 1974, the law changed. Many of the reasons on this list disappeared overnight, not because the attitudes changed, but because writing them down was now required. Some things only stop when someone has to sign their name to them. The next video answers the question of what happened the moment that law passed. Women did not wait for the banks to change. Some of them built their own. That story is next.